Good morning, ladies and gentlemen. Well, the risk dial still isn't fixed because it's not updating when it should all the time. It updates sometimes, but as you can see, it hasn't updated since the 14th. And I bet you that we are in daily risk off at the moment because basically the moving averages are rolling over. It's a function of time as opposed to a function of a bear market in equities. But we will examine all those details in the equities section. What I would like to say is a general position that I believe that we are in is that we are in a very big range which is going to last a very long time. Well, we've had a very exciting week in terms of bonds, or what was supposed to be a very exciting a week with the Fed, the ECB, and the Bank of England, and a whole load of other central banks. And the net result for the yield curve is, well, not much. Everything that the market thought has been confirmed by the central banks. The Bank of England hiked 15 basis points. When people weren't expecting it. The ECB was as dovish as ever. That's not going to change. And the only part of the yield curve that looks like it could continue to flatten is the 2s, 10s. I find it incredible that the 2s would make a low when the Fed confirms that he's on a tightening course. And it's not going to happen. I mean, the 2-year note is the only really vulnerable part. I think that whether we continue to trade between this 75 and 85 area for a while and then break down into the 50s, but into the 50s we go at some stage over the course of the next 2-3 months. The other parts of the yield curve are taking a well-deserved rest. If we look at the weekly chart of the 5s, 30s, really the difference on the week is minimal. I would have thought we stay in this kind of range for quite a while. I mean, here we stayed for what, a quarter, within a, 10-15 basis point range. I think much the same needs to happen here. If we look at it on a daily basis, we will see that basically these moving averages need time to catch up, and we need to be basically going up and down in this 15 to 20 basis point range for quite some time. Even the 5s, 10s, at these kind of levels, they really need rest like they did here. If we go through that is going to indicate some kind of a recession, that the market is really pricing in a recession. That I find very hard to square with what the Fed governors have been telling us, and that is that they see a very strong economy, very strong rebounds in economic activity despite the Omicron uncertainties. And that would be very, very significant if we start going through this, basically 10 basis points in 5s, 10s. The market is, just screaming the possibility of a negative yield curve and recession. That's why I just can't anticipate that kind of a move in the very short term, because I just don't think there is any reason behind it. Not that we're seeing from the data, but the yield curve really does give you a very good clue about what is going to happen. And if things start going in that direction, I'll be watching this chart very, very carefully. Then really the bond market is screaming recession. If we look at the individual tenures, the only one that I really want to get short of and long of yield is the 2-year note. I will add anything around the 50 area. To me is a bit of a bargain. The Fed has said 2 to 3 hikes starting in, well, nobody knows, any time around May, I would have thought. So the 2-year note, the odds of it going substantially below 50 are very, very low, and the risk reward at 50 is overwhelming for a move to around these levels, around the 80 to 85, 90 basis points. So I will keep on plugging away at that one. I really see no I mean, the odds of the twos making a low just as the Fed embarks on a tightening course, to me, are almost negligible. At some stage, we have to start trading into the 80s and 90s, anticipating more hikes in 2022 and the continuation in 2023. If that doesn't happen, then there is something really wrong with the market, and I just don't expect it. All the other 10-years, the 5s, they're asleep. Basically, it's 116 basis points. What do you want to do? And I think that we will remain at these levels in 5s, also in 10s. We will remain around this 139 to 150 basis point area for quite some time. I don't think it's very significant that we're trading below the 200-day moving average. To me, it's a flattening. We will just continue trading in this range, and also in the 30s. We keep on bouncing off the 190, trading between 175 and 190 basically. I just don't see any reason for things to change very much in the next couple of weeks. It's a period that the market needs to digest information it has, and the possibility that the Omicron wave is somehow worse than the market has priced in. Don't forget that the market has priced in quite a bit for this Omicron wave. It's unlikely that we just keep on collapsing in the 5s, 10s, and 30s in yield. It's unlikely to happen. To me, it's just a wait-and-see market that for the next couple of weeks until year-end is just going to be in a 10-15 basis point range. This is the differential between 10-year notes and bonds. And I think it's very significant that we're not moving away from this 182 basis points, very important swing level. A lot of people confuse absolute and relative rates, and a lot of people don't understand that QE leaks. If any central bank does QE, that via the foreign exchange market can be transmitted to any other bond market. The fact that the ECB is so dovish and will continue with their QE program is actually maintaining stability in the bond market, in the US bond market, as well as in the Bund market and Germany, Europe in general. The fact that the Bank of Japan is doing it, the fact that the Bank of England is continuing doing it, are all stabilizing factors for US treasuries as well. So, really, the signal for any move in towards higher bond rates in general will be a move down in this differential. To me, these levels are very, very important down here, around this 159 basis points. We started the year here at 152 basis points. So what has happened during the course of the whole year, where we've anticipated rates moving up in the US, and where short-term rates have moved a good 50 basis points already in the US, we have had a move of 20 basis points only, 25 let's call it, in the differential between 10-year notes and bonds. That shows you how much leakage there is out of the ECB QE into US Treasuries. To me, the only way US rates in any tenure are going to move substantially higher, apart from the very short end, i.e. Eurodollars and twos, that kind of thing, 2-year, 3-year, anything 5 years and beyond, the only way that that is going to move considerably higher in yield is if the European rates allow it. And therefore, to me, it's becoming more and more important to look at European yields over the course of the next year to give you a clue as to what is going to happen in US rates. This is a chart of the Schatz, the 2-year in Germany. This is where we started the year, and this is where we're ending the year, basically within a couple of basis points. You can see what a good job the ECB has done of maintaining the market within a very tight range. I mean, this is what, 78 to 64, that's 14 basis points throughout the year, and we're ending right in the middle of it. This will be the signal. When this starts moving and remaining above 64 basis points, that will be the signal that the ECB is relenting. It's slowly allowing rates to move higher. Until that happens, basically the differentials, the yield curve in Germany is going to move 5, 10, 15 basis points, but that's all it's going to move. When these rates start moving higher, that will be the signal that we can have higher rates and that the leakage will stop. There will be all diminish, basically. So that will be, if we have a look now at fives, this is the bobble. We can basically see that where did we start the year? We started the year here, and we are seeing the year finish, not even 6 basis points higher. So the yield curve in Germany is slowly steepening, but at a microscopic rate. Basically every time it drops here into minus 68, 69, it's going to be a wonderful opportunity to short it. The risk reward here is just overwhelming via options. And if we look at the 10-year note, the Bund, you see more or less the same thing. Where did we start the year? We started the year here at minus 59, and we're at minus 37. So that is you can see the steepening. This is 22. The fives were a dozen. So definitely the yield curve in Germany is steepening as opposed to the yield curve in the US, which is flattening, which is a classic sign of the QE leaking. Anytime we get towards this minus 48 area, it's going to be a wonderful opportunity via options to look for it to steepen further. So I'm looking for a further steepening of the yield curve in Germany, and I'm looking for a further flattening at some stage, especially in the front area of the 2s, 10s. And the real signal for 2s and the rest of the Eurodollar curve going again will be only given by the Schatz, I believe. When the Schatz and the yield curve in Europe starts flattening as opposed to steepening, that will be the signal that the ECB is giving up with its QE program. It's allowing rates to move higher, and when that happens, that can be the next leg for the longer tenures in the US to start going up and catching up with inflation. Until then, the leakage of QE out of Europe, out of Japan, out of England, and every other central bank that's doing QE will keep and suppress rates in the US. The one thing that can be said about the Wednesday's Fed is that it managed to calm down the inflation expectations. I actually was thinking that you would get a bigger move down, but basically what they've managed to do is return the inflation expectations to the level that they have been for the past 6 months, let's say. And I don't know whether it continues down. I'd be surprised if we go down through these lows. That would definitely mean that we are in that we can see appreciation in the longer tenures, i.e. the 10s and the 30s, that we can see them go up in price, down in yield. I don't think that is going to happen. I think these inflation expectations, both the 10-year break-even inflation rate is going to remain within these ranges, and more importantly, this one, which is the 5-year forward inflation expectation, 5-year forward inflation expectation rate that Powell really looks at, that it's important that it stays within this range. And I think the Fed's done a good job of maintaining it within a few basis points. You can see that we were basically here at the beginning of the year. And that to me makes a lot of sense. We tried to go higher, couldn't, but we're maintaining this kind of level. Only if it starts going higher, we will see a significant move higher in yields. While that does not go higher, the way they manage it is by allowing the front end to tighten, and that keeps the back end stable, and that gives us a low terminal rate, and that low terminal rate in turn supports equity valuations. They're getting the best of all worlds at the moment. How long it lasts, who knows? But these are the things that you have to look at. This will be the ultimate arbiter of where we go in bond yields next year. While it's in this range, with a bottom around the 2 area, you will not get a spike in bond rates. Absolutely no way. The pressure will actually be on the downside. Only after that, if we start moving higher than this 240 area, then you will see a very big flattening of the yield curve, because the Fed will really start tightening. But also the terminal rate should go up as well. The terminal rate now, with bonds where they are at around the 185, 190 area, and with the euro dollars where they are into 2024, 2025, everything below 2%, well, that will no longer be the case. Everything will start moving above 2%. And the yield curve will continue to flatten, and that could very well cause a recession at some stage, even if it's only a technical recession. But the economy should not be able to take it very well, and that will remove the support to equities. But that is a story for next year. For the time being, all we know is that the Fed is maintaining this range by allowing the yield curve to flatten, taking up via the movement of the 2s upwards. It's managing to contain this expectation. When it no longer manages it, and if it no longer manages it, then it'll be time for the Fed to act as opposed to talk about what it's going to do next year. And that will be the time that the market needs to prove itself. And the transfer mechanism for the QE leakage, of course, is the foreign exchange market. And here we have what happened last week. Basically, every time there was a pullback in the dollar, it got bought. The ECB is very, very, very determined to keep rates where they are for the time being. And that basically is pushing up the US dollar. As it just a no-brainer at the moment. You borrow in euros and you basically then buy US Treasury yielding, your 170, 180 basis point differential, and that's it. And that pushes up the value of the dollar. To me, these lines will trade. You can see how many times we traded here on the dailies, basically looking anywhere around the 98.30 level over the course of the next few weeks. If we have a look at what that means in terms of the Euro USD, it seems to me that these kind of levels around 110 down to this very important level, you can see how many times we traded there, 110.17. It's almost certain to get there over the course of the next month, or even just below 110. But basically, I'm targeting this 110 area or very close to it over the course of the next several weeks. Gold, well, it's just a leave alone, isn't it? On a daily basis, 1764 is very, very important. It just doesn't close below there. Every time it gets to 1764, there are buyers, and the market just basically just bounces back up into the 1800s. But basically just not breaking 1830 either. So it's a 1764, 1830 market. It makes sense. Bonds are doing nothing and will probably do nothing for the next couple of weeks. And the US dollar is very, very slowly and gradually appreciating. In fact, over the course of the last week, it did nothing. And that allowed gold to bounce a little bit. But there is really no real inflationary pressures that I can see, and I will touch upon that a little bit later. But for the time being, basically, it's an 1830, 1764 market. I can't see what's going to get it out of this range in the immediate future. But when it does, we'll be prepared to react. I still think that the odds are that we break down one last time, take out all the stops, and then, only then, we'll be in a position to go higher. The one that is actually becoming slightly more interesting is silver. I have marked this level here, 1935. I've got my bid just above it. I think we can, if I'm right about gold making one final low, we will get that kind of a fill down here around 19 or something like that, the low. And then I think he'll be in a position to react off this 200-week moving average and push it up towards the 22 to 24 area. But the fact that silver has not been able to rally at all, just tells me that you will get a disappointment and a move down to this 1935 to 19 area. And that should be a decent buy for a move back up. I just can't get all that excited about any of these commodities, but I think it'll be worth a shot at that level to the long side. DBC also, very little is going on. I think the odds are probably that we do some kind of an ABC over the course of the next few weeks and months, and this 1868 to 1841 area will then become critical. We have this area to fill. It would be nice if we got in there. I think the odds would be then overwhelming that we need to go higher. It's just unlikely that we don't have a spike up, given that basically we were here in 2015. There is no way commodities, with the kind of inflationary pressures that we've had and everything else, should be at the same prices in 2015. I think they should be quite a bit higher. And therefore, at some stage, if we see this 1868, 1841, I think call spreads are definitely worth having. I want to start this week's equity review with this highlighted in white moving average, which, it gives me a very good sense of where what kind of stage the market is in. The only flattening of that that I could find that was significant or similar was basically this period here in 2016, and every time that happens, you get some move down at some stage. The market is basically in a distribution phase, and that is what I think is probably happening at the moment. If I enlarge this, I think the odds that we will be able to turn it in the short term are not good. So basically, whether we trade 4,700 during a a few days of Santa rally or not, to me becomes irrelevant. It needs to be, we need to turn it up, and therefore I think it's going to be a question of time. And time here is becoming negative. Time is not working in favor of the market at the moment. I think it's much more likely that we will have spikes down towards this 45-36 area where the market will eventually bounce. And what we will do is get a confluence of the price and the 200-day moving average at a higher price, somewhere probably in the 4400s. That is the kind of thing that I'm anticipating for the market just by looking at this, what has been happening over the past few weeks. If I didn't look at any spread, that is what I would expect. But the spreads are actually confirming that point of view, and we will look at those too. I think this chart is becoming more and more important because it marries my view in bonds, which is stability until and unless we get a de-anchoring of the five-year forward inflation expectations, which I don't expect anytime soon, because I think the Fed has, successfully compressed that for the time being. That anchors the possibility that we break the 20 times forward earnings Blue Angel. So that gives us a bottom somewhere in the 4400s. While these lines keep on going upwards, this bottom is coming closer and closer. That's why I don't think we can have a particularly strong down move which lasts, which is not retraced. But also, I'm not expecting these forward earning lines to just keep on rising forever. I think a period of sideways trading, like we probably had here in this kind of 2015 area, is more likely than not. And you can see what happened in 2015. We kept on trying to go up and failing, but eventually we found the bottom. And when these lines turned again, then we started going up. I think that we need a period of decent consolidation here, and I think we will have dips towards the 20 times, but the fact that the bond market is not going anywhere significantly higher in yields at the long end is going to anchor the possibility of bigger falls in the S&P. And the reason that I just cannot see the S&P powering higher is because to do that we need NQ. We need the high beta stocks to participate, and at the moment they're just not. This is an enlarged weekly chart. It's quite possible that we get an ABC kind of move, which takes us down to the 15,111 area, which is going to be very, very important. And that's just, an ABC down. It's not bearish. It's just bearish short term. It's on this 195-minute chart, it's quite clear that basically 16,400 is as high as the market can get. We just can't get through there, and we need the market to get through there to get any kind of impulsion going in SPX. To me, it looks more likely that after a period of faffing around, at some stage we break down, accomplish this ABC, and then go higher, which all tells me that for the next several weeks the market might try to go higher, but it's going to keep on failing to do so. What would I love to see? I'd love to see this area filled, which is 14,800, and I think that the risk reward there is overwhelming to the upside. And are we going to get it? We're not. But until and unless we start breaking this 16,400 area and maintain a weekly close above it, I just cannot see SPX doing anything better than 4704. Okay, this is a chart of IWM, which is the Russell. Much has been made of what happened on Friday in high beta stock. It's quadruple witching. It's a Friday afternoon, probably the last Friday afternoon that anybody would be trading in size before year end. And you're bound to get some moves which, probably make no sense and get reversed. So much has been made on the bounce that we had on Friday between the Russell, high beta stocks, etc. I don't see it as particularly significant. The Russell got so smashed that, this area is so important. As you can see on the weekly, this is a weekly chart and this is a 195-minute chart. You can see the importance of this 211 area and 210 odd here on the weeklies. And all we did is bounce off it by a couple of percentage points. Wowee. I mean, we've fallen, how much we've fallen? From 250 to 210. Was that 20%? And we get a couple of percent bounce, and everyone says that high beta now is the flavor of the week. Basically rubbish. The 200 period moving average is still negative. We still have a whole load of room to bounce before it starts getting even remotely positive. To me, the Russell is showing nothing but stability. It's showing that it's vulnerable to breaks to the downside and then big rallies. That's all it's showing to me. If we look at other things like the transports and also the Dow, there's nothing there. Is there? There's absolutely nothing there. Everything is converging towards the 200-day moving average, and that is what I think is going to happen in S&Ps too. Over the course of time, as the market tries to go up and fails, and the 200-day moving average comes up, that's what's going to happen. It's going to bounce between the 200-day moving average and the top of the Bollinger Bands. 200-day moving average, top of the Bollinger Bands. A classic sell options strategy, that is going to work over the course of the next 2 or 3 weeks. So let's examine this high beta story in many different ways. This is a chart of SPY over IWM. This is a weekly chart, and basically on the week we did absolutely nothing. But you can see how much we have come from the beginning of the year. And really, to me, this is very much some kind of a rounding bottom. But is this the level that you're going to go all in on high beta? I don't think so. I mean, it's not really. This is probably the level to do it. This to me looks, the risk reward is very meh. I think. I remember at the beginning of the year, people were with me that we were desperately trying to find a bottom in this. And actually went far further than I thought, but here we are. To me, this is not the time to go after high beta. Yes, there will be bounces. To me, this is a part of the cycle that you want to be defensive for at least another month or so. I think this year the Santa rally and the January rally are probably going to get inverted, that we're going to get very little at the beginning of the year and probably back end the rally in S&Ps and equities in general, simply because there's too much uncertainty around. We have the Omicron wave, we have the uncertainty about when Fed hikes start. All those things are going to dampen the first part of the year and backload any performance to the second half of the year, let's call it. Another way to look at it instead of IWM is to look at VTI, so the totality of the stock market over SPY. And these lines go back to, when God was a boy, basically. You can see how much VTI has outperformed since going back to 2000, to the early 2000. But these lines have been very important for a very, very long time. And if we look where we are basically, at the average of where we have been for the past decade. So is it time to pile in to the rest of the stock market as opposed to the SPY? I don't think the level is particularly good risk reward. I'm just showing you this because, if you think that high beta is particularly good risk reward, no, not really. And this is SPHB, so the high beta against SPY. Is it particularly good risk reward? No, it just isn't. I really would not move away from the index at the moment. I don't think it's time to be brave. I think it's a time to be defensive. Are you going to get rallies? Absolutely you will. But I just don't think that this is the timing to go all in on high beta. It's just, it just feels like it's gone a long way. It hasn't, not really. One final way of looking at it, this is where we started the year, right here. And where are we? Exactly the same level. So basically, the performance of NDX and SPY has been identical over the course of the year. Does that mean anything? I don't particularly think it does. I think it's showing stability. It's showing the inability. Excuse me. Showing the inability of NQ to lead. And if that is the case, a period of stability while we get moves of different magnitudes and speeds in different sectors, which readjust the indices. One day one sector is down more than the other, and that pushes down because of its weighting. It pushes down the S&P more, and the next day it retraces, and the S&P retraces itself. That is going to keep on happening. And that is why I see a period of stability overall in the indices, with swings of 2-3% down, 1-2% up over the course of the week. To me, a classic sell strangles time. I wanted to show you a chart of the more value-oriented indices like the stocks. It's showing basically that we are in a range between, let's say, 4,000 and 4,240. The Omicron debacle is going to be worse in Europe than it's going to be in the US for sure. And if this index is going to be stable and not break these lows around the 4,000 level, then SPX is unlikely to go below that 4,500 area that it tested a couple of weeks ago. To me, this is again another sign of a period of stability, with spikes lower as some piece of bad news hits. But the fact that the bonds are anchoring, as I showed you, it's unlikely to break much below 4,500, simply because the Blue Angels and the multiples are going to be rock solid at those levels. And one last chart, the VIX. You can see that every few weeks, let's call it, you get another spike in volatility, which basically fills the levels that it left open several weeks back. And that level is going to be up to here, 27.20. That's where we have a gap up towards. A few days of trading, 20, 21, up to 27. That seems to be the pattern, as you can see on the weeklies, absolutely the pattern. You have, the weekly, and I can even enlarge this. You have the weekly moving averages all going, basically supporting it. Every time it goes to to this 2680 level, it comes back. That's the kind of level that I'm going to look for to to give me a timing in the market for the lows in SPX. And that is another piece of evidence that basically confirms that at some stages you get those moves down. And as I showed you on that first chart I showed you, that is slowly turning that very important moving average. Let's go back to it. So to me, what we are likely to see over the course of the next several weeks is basically moves down which bounce off either 45.35 or 44.78 or even 44.23. But, the market will be supported. To me, when you start selling short-dated options which are priced ridiculously highly at these strikes, to me that is going to be basically money in the bank. I've updated the levels. I don't think we're going to get much movement next week. To me, if we see 45.37, it's a great area for a bounce next week. And below that, I will update you. You have the 44.80 level. And then, I very much doubt it goes through. So these are the levels, and really NQ should lead us both to the upside and the downside, unless 16,400 gets broken and we close above it. I really can't see many rallies in SPX. And basically it's as simple as that. I've updated all the other levels. to me, the dollar going up is, basically you sell the RIP in Euro USD. Every time it happens, it comes back, and I think it makes sense because the leakage of the QE that's happening in Europe has to be transmitted somehow, and DXY to me is the obvious way. Thank you very much indeed, and tweet you on Monday.